I want you to picture a scenario that's honestly playing out right now in neighborhoods all across the country.
Okay.
Imagine two identical investors. Like, let's just call them neighbors.
Right.
They live in the exact same kind of suburban house. They drive the same mid-tier sedans. They've had the exact same career trajectory in middle management.
Very typical American dream setup.
Exactly. And over the course of their 40-year working lives, both of these individuals carved out the exact same amount of money from every paycheck to invest.
So all the inputs are identical.
Completely identical. Both of them earned the exact same annual return on those investments. And after 4 decades of the daily grind, they both retire on the exact same Friday afternoon.
Love that.
Right. And they both have portfolios worth roughly $2.5 million.
That is a very solid retirement.
It is. They're clinking glasses at the neighborhood block party. I mean, they won the American retirement game.
Yeah.
But, and this is the crux of it here, was where the story splits in a way that just fundamentally alters the rest of their lives.
Yeah, the divergence in their actual lived reality in retirement is just staggering when you look at the underlying mechanics of those two portfolios.
Because 5, maybe 10 years into retirement, one of these neighbors is bleeding cash.
Mm-hmm.
Every single time they want to buy a new car or take a trip or honestly just pay their rising property taxes, they have to pull money out of their retirement account, and the IRS is right there.
Right there waiting.
Waiting and taking 20, maybe 24% right off the top. I mean, they are paying tens, perhaps hundreds of thousands of dollars in taxes on their own savings.
Yeah.
But the other neighbor is legally paying 0 federal income tax on their withdrawals.
Nothing at all.
Nothing. Not a single cent. The IRS doesn't even ask for a cut. I was looking through the historical tax data and the legislative frameworks we're covering in our deep dive today, and we really have to break down how this is mathematically and legally possible.
We do, because it sounds made up.
It really does. I mean, the difference between losing a fortune to the government and keeping every single penny, it isn't about one of them being some Wall Street genius who timed the market perfectly.
No, not at all.
It's entirely about the specific tax classification of the account they opened when they were in their 20s.
Yeah, it represents a complete inversion of how Americans were historically taught to think about wealth and, taxes.
Right.
We're so conditioned to believe that taxes are just this inescapable gravity that pulls on your wealth the richer you get. But what you're describing is the designed function of the Roth IRA.
The Roth.
The Roth.
Yeah.
It was introduced into the tax code back in 1998, and it has quietly become, honestly, the single most powerful legal tax shelter available to the American middle class.
So let's set the parameters for this conversation right now.
Yeah.
Because we aren't just going to throw dense financial jargon around today.
No, nobody wants that.
Right. This isn't a lecture on complex offshore trusts for billionaires.
Exactly.
We are looking at a roadmap built for ordinary W-2 wage earners. We're talking about teachers, nurses, engineers, construction workers. This is a tool specifically designed to build generation-spanning wealth.
It really is the ultimate equalizer.
So our goal today is to tear down the engine of the Roth IRA. We need to understand the mechanics, the literal math of the tax code, and the strict rules governing it.
Mm-hmm.
Because your gross investment return, like the percentage you see flashing green on your brokerage app, is really only half the equation.
Only half.
The other half, the half that actually dictates whether you are flying first class or clipping coupons in retirement, is what you legally get to keep after the government takes its share.
Yeah, and to understand those mechanics, you really have to understand the economic problem Congress was trying to solve in the late 1990s.
Okay, take us back.
So if we go back to 1997, Congress passed the Taxpayer Relief Act. At the time, the traditional retirement tax formula that Americans had been using for decades was showing some behavioral flaws.
Right.
People just weren't saving enough. So a senator from Delaware named William Roth proposed something highly unusual. He proposed completely reversing the timeline of retirement taxation.
Because before 1998, the standard advice from like every accountant in the country was to use a traditional IRA or a traditional 401k model, the whole pay me later approach.
Exactly. The traditional model is based entirely on tax deferral. It gives you a tax deduction today.
Right.
So if you earn, say, $70,000 and you put $5,000 into a traditional IRA, the IRS taxes you as if you only earned $65,000 that year.
So you get a nice immediate benefit.
You do. Your investments then grow for decades without being taxed year to year. But, and there is a massive catch here.
There always is.
Right. When you finally retire and withdraw that money, the government taxes every single dollar of it as ordinary income. They get their cut of your original money, plus a cut of all the growth.
So the government is basically acting like a silent partner in your portfolio.
That's a perfect way to put it.
I mean, they let you do all the hard work of saving and investing. They let you take all the market risk, the stomach-churning dips,
A little bit.
and then they swoop in at the end and just take a quarter of your profits.
Exactly. Senator Roth's proposal offered the exact opposite deal. His framework was, pay your taxes right now, up front, on the small amount of money you are contributing.
So no deduction today.
Right. Do not take a tax deduction this year. But in exchange, the government agrees to never, ever tax that money or its compound growth again, provided you follow the withdrawal rules.
I want to lock this in with a classic agricultural metaphor because I just think it perfectly explains the mechanism for anyone listening.
Oh, yeah, the seed and the harvest.
Right. So if you are a farmer, you have to buy a bag of seeds in the spring to plant your crop. The traditional IRA is the government saying, hey, don't worry about paying a tax on that bag of seeds today. Plant them.
Just go ahead and plant them.
But in the fall, when those seeds have turned into 10,000 pounds of corn, we are going to tax the entire harvest.
Every single ear of corn.
Exactly. But the Roth IRA is the farmer saying, no, I will pay the sales tax on this little bag of seeds right now in the spring. But when I harvest those 10,000 pounds of corn in the fall, every single kernel belongs to me.
That is the precise economic mechanism. The Roth IRA is funded strictly with what the IRS calls after-tax dollars.
After-tax dollars.
Right. When your employer hands you your paycheck, they have already withheld federal and state income taxes.
Yeah, we all see that chunk missing.
Sadly, yes. So the money hitting your checking account has already been taxed. When you move that already taxed money into a Roth IRA, you have paid the toll on the seed. The IRS has been satisfied.
Yeah.
Therefore, every single dollar of capital appreciation, every dividend, every interest payment generated inside that account from that point forward compounds in a completely tax-free vacuum.
Okay, let's run the actual numbers on this because human brains are just notoriously bad at intuitively understanding compound growth over long time horizons.
We really are. We think linearly, not exponentially.
That's exactly.
Yeah.
So let's look at a young investor. Suppose a listener is 25 years old right now, and they decide to carve out $500 every single month to invest.
Okay, solid start.
That's $6,000 a year. If we assume an average annual return of 10%, which tracks roughly with the historical long-term average of the S&P 500 before inflation, what is the actual mathematical progression of that capital?
So the chronological milestones are where you really see the separation between the seed and the harvest. You start at 25, investing $500 a month.
Okay.
By age 35, a decade later, you have personally contributed $60,000 out of your own paycheck.
Right. 12 months times 500 times 10 years. 60 grand.
Yep. But your portfolio, assuming that steady compounding, has grown to approximately $105,000.
Wow. So you've essentially generated $45,000 of free capital.
Correct. But the curve gets steeper. By age 45, your total lifetime contributions have reached $120,000. Yet, the account balance is now sitting around $380,000.
So the growth is now vastly outpacing the principal you put in.
By a very wide margin. Now we hit age 55, your out-of-pocket contributions total $180,000. But the portfolio is approaching the $1 million mark.
That's incredible.
And if you simply maintain that exact same boring, consistent behavior until age 65, your account exceeds $3.3 million.
Okay, I have to stop you there and push back slightly on behalf of the listener.
Sure.
A 10% annualized return sounds incredible in a spreadsheet, but the stock market doesn't move in a straight line.
It definitely doesn't.
We have years like 2008 or 2022 where the market drops 20 or 30%. Does this mathematical model actually hold up in the messy reality of market crashes and bear markets?
It is a vital distinction to make. The stock market is highly volatile in the short term. You will absolutely have years where your portfolio loses value. But the 10% figure is the historical annualized average over rolling 30 and 40-year periods. When you are contributing $500 every single month, you are naturally executing a strategy called dollar cost averaging. Dollar cost averaging, yes. When the market crashes 20%, your $500 that month buys shares at a 20% discount.
Ah, so you're buying them on sale.
Exactly. You accumulate more assets when prices are depressed. When the market eventually recovers, those cheaply acquired shares amplify your gains, which historically pulls your long-term return back toward that historical mean.
Okay, see.
So while the path to 3.3 million will be incredibly bumpy, the mathematical destination remains highly probable over a 4-decade horizon.
And the most important part of this entire scenario isn't just the 3.3 million. It's the composition of that money.
Yes.
Out of that final balance, only $240,000 came from the listeners' actual paychecks over those 40 years.
Think about that.
More than $3 million of that balance is pure compound growth. It is the harvest. And because this happened inside the Roth tax wrapper, the federal government cannot touch a single cent of that $3 million.
That is the paradigm shift. You generated $3 million of invisible wealth that the tax code just completely ignores.
Let's quantify exactly what ignoring that wealth means in dollars and cents. Because we talk about tax savings in the abstract, but let's look at the alternative.
Okay, the standard brokerage route.
Right. What if our 25-year-old investor built that exact same $3.3 million portfolio, but they didn't know what a Roth IRA was, so they just used a standard taxable brokerage account? What is the actual consequence of that mistake?
The financial consequence is severe. In a standard taxable brokerage account, you face multiple layers of taxation.
Like what?
Well, first, you suffer from tax drag along the way. Every time a stock or a fund in your portfolio pays a dividend, you owe taxes on that dividend in the year it was paid, even if you reinvest it.
So it's constantly draining your momentum.
Exactly. It constantly drains a little bit of capital out of your compounding machine, meaning you likely wouldn't even reach the full 3.3 million.
Right.
But let's just assume you did. When you reach retirement and you start selling those assets to pay for your life, every dollar of profit is subject to capital gains tax.
And what does that tax bill actually look like in retirement?
If you are withdrawing substantial amounts to fund a comfortable retirement, you could easily face a 15 to 20% effective tax rate on those capital gains, depending on your state and federal brackets.
Okay, so on $3 million.
On $3 million of growth, a 20% tax hit means you are surrendering $600,000 of your wealth back to the government.
$600,000. I mean, that isn't just an administrative fee.
No.
That is the entire purchase price of a home. That is fully funding your grandchildren's university tuition. That is potentially a decade's worth of living expenses just vaporized because you didn't check the right box when you opened the account.
It perfectly illustrates why minimizing your legal tax burden is just as critical to wealth creation as picking good investments. We spend so much time obsessing over trying to beat the market by 1%, when simply utilizing the correct tax wrapper can automatically increase your net retirement wealth by 20%.
But if the math is this decisively in favor of the Roth, it begs a massive question.
Go ahead.
Why would anyone ever use a traditional IRA? If the Roth saves you over $500,000, is there a catch? In what scenario does the traditional pay-me-later model actually win?
That's a great point. The decision between traditional and Roth is fundamentally a calculated bet on your future self, specifically regarding your marginal tax brackets.
Okay, explain that.
You have to compare your tax rate today against your expected tax rate in retirement.
Well,
If you are a 24-year-old making $50,000 a year, you are in a very low income tax bracket.
right.
Paying the taxes today on your seed money costs you very little, but 40 years from now, you might have a massive portfolio generating huge streams of income, pushing you into a much higher tax bracket.
Oh,
In that scenario, the Roth wins by a landslide. You paid taxes when your rate was low and avoided them when your rate was high.
okay, but what's the reverse scenario? When does traditional win?
Imagine a 55-year-old surgeon at the absolute peak of her career, earning $600,000 a year.
Okay, making serious money.
Right. She's in the highest possible federal and state tax brackets. Every dollar she earns right now is being taxed at roughly 45 or 50%.
Ouch.
But she plans to retire in 5 years, move to Florida, and live a much simpler lifestyle where her income will drop dramatically.
Oh, I see where this is going.
For her, paying taxes today at 50% makes no mathematical sense. She should use traditional pre-tax accounts, take the tax deduction today to shield her current high income, and pay the taxes in retirement when she expects to be in a much lower 20% bracket.
That makes perfect sense. It's an arbitrage game with your own lifetime tax rate.
Exactly. It's all about arbitrage.
But for the vast majority of younger listeners, or honestly anyone in the middle class who expects their career and wealth to grow, the Roth is the mathematical favorite.
Without a doubt.
But the government rarely just hands out free passes. If they're willing to let you have millions in tax-free growth, they must be capping how much seed you can plant in the first place.
Oh, they absolutely cap it, and the guardrails are strictly enforced. Congress wants to incentivize middle-class saving, but they don't want billionaires sheltering billions of dollars from the IRS.
Oh, naturally.
So for the 2026 tax year, the IRS limit for individual contributions is $7,500 per year if you are under the age of 50.
7,500. Okay.
If you are 50 or older, they allow a catch-up contribution of $1,100, bringing your maximum to $8,600.
Okay, that's not huge, but it's something.
And a crucial rule here, that limit is aggregate across all your IRAs. You cannot put $7,500 into a traditional IRA and another $7,500 into a Roth in the same year.
So the absolute maximum you can shield from taxes is $7,500 a year. It really is designed to reward slow, incremental consistency rather than sudden windfalls.
Very much so.
But what about income limits? I know there is a threshold where the IRS says you make too much money to participate.
There is, and it's based on a specific calculation called Modified Adjusted Gross Income, or MAGI.
Wait, let's break that down. MGI. How does the IRS calculate my MGI compared to just the gross salary my boss pays me?
Right, so your gross salary is just the starting point. To find your adjusted gross income, or AGI, you take your total gross income and subtract specific allowable deductions, like the money you put into a traditional 401k at work or contributions to a health savings account.
Okay, so that gets me to AGI.
Then, to get from AGI to modified AGI, the IRS requires you to add certain things back in, like student loan interest deductions or foreign earned income exclusions.
Sounds complicated.
It can be, but for most standard W-2 employees, your MGI is going to be very close to your gross salary minus your traditional 401k contributions.
Okay, so once I calculate my MGI, what are the actual thresholds for 2026 where I get locked out?
For a single tax filer in 2026, if your MAGI is below $153,000, you are clear to contribute the full $7,500 directly to a Roth IRA.
Awesome.
If you earn between $153,000 and $168,000, you enter a phase-out zone where the amount you can contribute is steadily reduced.
Okay.
And if your MGI exceeds $168,000 as a single filer, you are legally prohibited from making direct contributions to a Roth IRA.
And what if I'm married?
For married couples filing jointly, full eligibility ends at $242,000, and it completely phases out at $252,000.
I have to interject here because this is where a lot of people feel incredibly frustrated by the system.
Oh, I know.
Like, if a listener studies hard, works their way up the corporate ladder, and finally starts making $170,000 a year, the government's response is to permanently punish them by kicking them out of the best tax vehicle in the country.
Yeah.
They just lose access to the wealth machine because they were successful.
It is the most common frustration I hear, but it is actually based on a massive misunderstanding of the tax code.
Really?
Yes. Earning over that limit prohibits you from making a direct contribution, but it does not permanently exclude you from the Roth ecosystem. This introduces a widely utilized mechanism known as the Backdoor Roth IRA.
The backdoor Roth.
Yeah.
I hear this term thrown around constantly, and frankly, it sounds like an illicit tax evasion scheme.
Oh, it does sound sketchy.
Right. Is this actually legal, or is it a gray area the IRS is trying to shut down?
It is entirely legal, explicitly documented in federal tax law, and utilized by millions of high-income investors. It is not a shady loophole. It is a mechanical two-step process.
Okay, lay it out for us.
Here is how it works. If your income is $200,000, you cannot contribute directly to a Roth. However, there are no income limits to contribute to a traditional IRA.
Wait, none.
None. So, step one. You contribute $7,500 in cash to a traditional IRA. Because your income is high, the IRS will not let you take a tax deduction for this. It is categorized as a non-deductible contribution. You are putting already taxed money into a traditional IRA.
Okay, step one is done.
Step two. A few days later, you instruct your brokerage to convert that $7,500 from the traditional IRA into your Roth IRA.
Let me get this straight. You just walk the money through the front door of the traditional IRA, turn around, and immediately push it through the back door into the Roth IRA, and suddenly you bypass the income limits entirely.
Precisely. Because the initial contribution was made with after-tax money and you didn't claim a deduction, the conversion to the Roth IRA is generally a non-taxable event. The money just settles in the Roth, ready to compound tax-free.
That seems almost too easy. There has to be a trapdoor here. What happens if I already have money in a traditional IRA from like an old 401k rollover? Can I still just backdoor my 7,500 cleanly?
That is exactly where the trapdoor lies, and it's a mechanism called the pro rata rule.
The pro rata rule.
This is critical to understand. The IRS views all of your traditional IRAs as one giant bucket. You cannot tell the IRS, hey, I only want to convert this specific $7,500 of after-tax money.
Oh, no.
Right. The IRS mandates that any conversion must be taxed proportionally based on the ratio of pre-tax to after-tax money in your entire IRA ecosystem.
Okay, walk me through the math on that. Let's say I have an old 401k that I rolled over into a traditional IRA years ago, and it has $92,500 of pre-tax money in it.
Okay, solid example.
Now, I try to do a backdoor Roth, so I add my $7,500 of new, non-deductible after-tax money. What happens when I hit the convert button?
In that scenario, your total traditional IRA balance is now $100,000. Of that total, $92,500 is pre-tax and $7,500 is after-tax.
Right.
That means your bucket is 92.5% pre-tax. When you tell your broker to convert $7,500 to a Roth, the IRS applies that exact same percentage.
Oh, boy.
Yeah. They will deem that 92.5% of your conversion, which is roughly $6,937, consists of pre-tax money.
And because it's pre-tax money entering a Roth, I have to pay income tax on that $6,937 this year.
Exactly. You will get a surprise tax bill. The pro rata rule means the backdoor Roth strategy works cleanly and beautifully if and only if you have $0 in existing pre-tax IRAs on December 31st of the year you do the conversion.
That is a phenomenal clarification. It's legal, but requires surgical precision if you have old retirement accounts floating around.
Absolutely.
Now, let's pivot to a completely different barrier to entry, one that stops a lot of younger listeners from even opening the account in the first place. I hear people in their 20s say all the time, I'm not putting my cash into a retirement account. That money gets locked in a vault until I'm 60 years old.
Right.
What if I lose my job? What if I want to buy a house?
Right.
The assumption is that contributing to a Roth is essentially giving up your liquidity for 40 years.
This is perhaps the most damaging misconception in personal finance, what financial planners often call the liquidity myth. We need to dismantle it right now.
Let's do it.
A Roth IRA does not lock all your money away forever.
Right.
We have to go back to the foundational mechanism of the account. You fund it with after-tax dollars. You have already paid the IRS their toll on the seed money.
Right.
Because of that, the IRS allows you to withdraw your original contributions at any time, at any age, for any reason, with absolutely zero federal taxes and zero penalties.
Wait, I really want to emphasize this because it fundamentally changes how people view saving. If I contribute $5,000 a year for 4 years, I have put $20,000 of my own money into the Roth.
Yep.
Let's say the market goes up and the total account balance is now $28,000. If I suddenly face a medical emergency or a job loss and I desperately need $15,000, I can just withdraw it. I don't have to wait until I'm nearly 60.
You can withdraw the $15,000 without penalty because you are only withdrawing from the $20,000 principal you contributed.
Wow.
The critical line in the sand the IRS draws is between your contributions and your investment earnings. Your contributions are highly liquid. The $8,000 of earnings, the compound growth, is what is heavily restricted.
Okay, so when do I get access to the earnings? What are the rules for unlocking the harvest?
To withdraw the investment earnings tax-free and penalty-free, you must satisfy 2 strict conditions simultaneously. First, you must generally be at least 59.5 years old.
Okay, standard retirement age stuff.
Second, you must satisfy the 5-year rule. The 5-year rule states that it must have been at least 5 tax years since you made your very first contribution to any Roth IRA.
Let's dig into that 5-year clock.
Yeah.
Because the IRS always has weird quirks about how they measure time.
Always.
If I open my very first Roth IRA and make a contribution today, does the clock start today?
Actually, the IRS gives you a generous administrative quirk here. The 5-year clock always starts on January 1st of the tax year for which you made the contribution.
Interesting.
Yeah, so if you wait until April 10th, 2027 to make a contribution for the 2026 tax year, the IRS backdates your 5-year clock all the way to January 1st, 2026.
That is fascinating. But what if I open a second Roth IRA at a different brokerage 3 years from now? Does that new account have its own 5-year clock?
No, and this is a great feature. The 5-year clock for direct contributions is tied to you as an individual, not to the specific account. Once you satisfy the 5-year rule for your first Roth IRA, you had satisfied it for all future direct Roth IRAs you ever open.
So the takeaway for a young listener who is worried about liquidity is this. You aren't locking your money away. You're building a dual-purpose vehicle. The contributions act as an ultimate emergency fund if your life goes completely off the rails, but if you don't need them, they fuel a tax-free retirement machine.
Exactly. It removes all the psychological friction of parting with your cash.
Let's bring this into the context of the workplace, because for most Americans, their primary exposure to investing is the 401k packet HR hands them on their first day of work.
The giant stack of paperwork.
Yeah, exactly. If an employee has access to a standard 401k, and they also know about the Roth IRA, how should they navigate between the two? Are these competing accounts?
They are complementary tools, but they have distinctly different strengths. A workplace 401k has massively higher contribution limits. For 2026, you can put up to $24,500 of your own money into a 401k, compared to just $7,500 in a Roth IRA.
Big difference.
Huge. Furthermore, standard 401k contributions are pre-tax, meaning they lower your taxable income today. But the most important feature of a 401k is the employer match. Many companies will match your contributions up to a certain percentage of your salary.
So if I make $100,000 and my company offers a 5% match and I put in $5,000, they just hand me another $5,000.
Exactly. It is a 100% instantaneous, risk-free return on your investment. There is no hedge fund on earth that can guarantee a 100% return on day one.
Knowing that, what is the optimal sequence of operations? If I have a limited amount of money to save each month, where does the first dollar go and where does the next dollar go?
Financial planners almost universally recommend a three-step sequence. Step 1. Contribute exactly enough to your 401k to capture every single cent of your employer's match. Never leave free money on the table.
Right. Never skip the match.
Step 2. Once you have secured the match, pivot. Direct your next available investment dollars to fully max out your Roth IRA up to that $7,500 limit. This ensures you are aggressively building a tax-free bucket of wealth to balance out the pre-tax money in your 401k.
I see.
Step 3. If you are fortunate enough to max out the Roth IRA and still have capital left to invest, return to your 401k and increase your contributions up toward that $24,500 limit to further reduce your current year tax burden.
Match, Roth, max the 401k. It's a crystal clear blueprint. But this brings up a foundational question about the Roth that I think still confuses a lot of people.
What's that?
When someone finally goes online, opens a Roth IRA, and transfers $7,500 from their checking account into it, what exactly have they bought? Is the Roth IRA itself a mutual fund?
This is a crucial distinction. A Roth IRA is not an investment. It generates zero return on its own.
Wait, zero?
Zero. A Roth IRA is merely a tax classification, a wrapper, or a specialized basket. When you transfer $7,500 into the account, that money just sits there as uninvested cash, earning practically nothing. You have to take the second step. You have to use the cash inside that Roth IRA wrapper to buy assets.
So what can you buy inside the wrapper?
Almost anything publicly traded. You can buy broad market index funds, target date retirement funds, individual tech stocks, dividend-paying utility companies, U.S. Treasury bonds, or real estate investment trusts.
Anything, really.
Yeah, the IRS doesn't care what investments you choose as long as they stay inside the basket. The Roth IRA simply acts as an invisible tax shield surrounding whatever you chose to buy.
I love the visual of the invisible tax shield.
Mm-hmm.
And speaking of the IRS shielding you, we have to discuss one of the most punitive mechanics of the traditional retirement system, something called required minimum distributions, or RMDs.
Oh, the RMDs.
If you are decades away from retirement, you've probably never heard of this, but it is a massive headache for retirees. Why does the government force RMDs?
It goes back to the government acting as your silent partner in a traditional IRA. You spent 40 years deferring your taxes. The government was patient, but eventually they want their revenue.
They want their cut.
They do. They will not let you defer taxes until you die and just pass the account to your kids untouched. So federal law dictates that once you reach a certain age, currently between 73 and 75, depending on your birth year, you are legally forced to begin withdrawing a specific percentage of your traditional IRA every single year.
And how do they calculate how much you have to withdraw? Is it a flat percentage?
No, the IRS publishes a life expectancy factor table. They look at your age and your account balance on December 31st of the previous year, and they use a formula to mandate your withdrawal amount. As you get older, the required percentage increases.
And because it's a traditional IRA, every dollar of that forced withdrawal is tacked onto your taxable income for the year.
Exactly. And this is where it becomes a nightmare for diligent savers.
Hmm.
Imagine you are 76 years old. You have Social Security, maybe a small pension, and you live modestly. You don't actually need any money from your IRA to survive.
Right, you're fine.
But the government doesn't care. They force you to pull out, say, $40,000 this year, which instantly spikes your taxable income, potentially pushing you into a higher tax bracket and causing more of your Social Security benefits to become taxable. It's a forced cascade of taxation.
But the Roth IRA avoids this entirely, right?
This is the Roth's ultimate structural advantage for wealth preservation. During the lifetime of the original account owner, a Roth IRA has 0 required minimum distributions. None.
Let's make sure the gravity of that lands. The government never forces you to withdraw your own money.
Never. Because you already paid the taxes on the seed money decades ago, the IRS considers the transaction complete. They don't care if you never touch the account. If you don't need the money, you can let it sit there, compounding tax-free through your 70s, 80s, and 90s. This makes the Roth IRA an unparalleled tool not just for retirement income, but for estate planning. You can leave a massive, entirely tax-free asset to your heirs.
That level of control is incredible. It shifts the power dynamic from the IRS back to the individual. I want to transition now into the behavioral psychology of all this.
Okay.
The underlying theme of our deep dive today has been the sheer power of time. We tend to have this cultural narrative that wealth is created by sudden, massive events, selling a tech startup, hitting a crypto jackpot, or inheriting a fortune. But the data shows that generational wealth is usually just the result of relentless, boring consistency over decades.
The math of compound interest heavily favors consistency over lump sums, largely because of how early dollars behave. Every dollar you invest in your 20s isn't just growing, its growth is generating more growth. The source material provided a fascinating comparison regarding monthly contributions. We previously discussed investing $500 a month for 40 years, yielding roughly $3.3 million at 10%.
Right, the $3.3 million.
But what if a listener simply doesn't have $500? What if they can only squeeze out $200 a month?
$200 a month is about $50 a week. It's essentially redirecting the cost of a few takeout meals.
Over 40 years, at that same 10% return, that $200 a month still produces roughly $1.06 million.
Over $1 million just from giving up some takeout.
Yes. But watch what happens to the math when you increase the contribution. If you bump it up to $500 a month, you are increasing your out-of-pocket investment by 2.5 times. But your final wealth jumps from $1 million to over $3.3 million, an increase of more than 3 times.
Why is the final result non-linear? Like, why does a 2.5x increase in savings result in a 3.3x increase in wealth?
Because of the physics of compounding. When you increase the monthly amount, you are planting more seeds early in the timeline. Those extra seeds have 30 or 40 years to undergo exponential growth. The earlier the capital enters the system, the more violently it compounds at the end of the timeline.
This concept is perfectly illustrated by a behavioral scenario we have to discuss. It's the ultimate lesson in time versus capital. Let's talk about the hypothetical investors, Emily and David. Break down their timelines.
This scenario is taught in almost every introductory finance class for a reason.
Right.
Emily starts investing early. At age 25, she begins contributing $5,000 every single year to her Roth IRA. She does this for exactly 10 years.
Okay.
By age 35, she has invested $50,000 of her own money. At that point, life happens. She decides to stop investing entirely. She doesn't pull the money out, but she never adds another dime. The account just sits there, compounding from age 35 to 65.
Okay, so Emily front-loaded a decade of effort in her 20s and then basically coasted for 30 years. What about David?
David takes the more common path. He delays. He spends his 20s paying off debt and having fun. He doesn't invest a single dollar.
Very relatable.
At age 35, he realizes he is behind and he panics. To make up for lost time, David starts contributing the exact same $5,000 a year to his Roth IRA. And David is disciplined. He invests that $5,000 every single year for 30 straight years, from age 35 all the way to 65.
So David invested $150,000 of his own money over 30 years. Emily only invested $50,000 over 10 years. Logically, you would assume David destroys Emily in final wealth.
But he doesn't. Assuming an 8 or 10% annualized return, Emily will finish at age 65 with a larger total portfolio balance than David.
I mean, let's just pause on that reality. David works 3 times as long, sacrifices 3 times as much of his own paycheck, and he still loses to Emily. simply because Emily started 10 years earlier.
It proves a universal mathematical truth. In the formula for compound interest, time is an exponent, while principal is just a multiplier. The first decade of compounding matters exponentially more than the last decade.
Oh.
Emily gave her money 40 years to compound. David only gave his first dollars 30 years to compound. He could never earn enough or save enough to catch up to the sheer physics of Emily's 10-year head start.
Which opens up a truly mind-bending application for any parents or grandparents listening right now. If time is the absolute most dominant variable in creating wealth, what happens if we push the starting line back even further than age 25? What if we start when a person first enters the workforce as a teenager?
Opening a custodial Roth IRA for a teenager is arguably the most powerful, underutilized wealth transfer strategy available to American families.
Really?
Yes. Under IRS rules, a child of any age who has legitimate W-2 earned income or documented self-employment income is legally allowed to contribute to a Roth IRA, up to the amount they actually earned.
Let's put some parameters on earned income. If I pay my 15-year-old son $50 a week to mow my own lawn, does the IRS consider that legitimate earned income for a Roth?
Generally, no. Household chores for parents usually do not meet the strict IRS definition of earned income. The child needs to have a formal W-2 job, like working at a grocery store, a fast food restaurant, or lifeguarding, or they need to have legitimate, documentable self-employment income, like a neighborhood landscaping business where they invoice clients and file a tax return.
Okay, so let's say my 16-year-old daughter gets a W-2 summer job at the local community pool, and she earns exactly $4,000 over the summer. What is the strategy?
If that entire $4,000 is invested into a custodial Roth IRA, and she never touches it until she reaches full retirement age at 66, a 50-year time horizon, assuming that historical 10% average annual return, that single teenage summer job contribution grows to over $450,000.
$500,000 from blowing a whistle at a pool for 3 months.
It's wild.
But I have to push back on the reality of a teenager's brain. If my 16-year-old makes $4,000, she wants to buy a used car or clothes. She is not going to voluntarily hand over her entire summer earnings to a retirement account she can't touch until 2076.
And the IRS doesn't require her to. The rule states that the contribution amount cannot exceed her earned income. It does not dictate where the actual dollars deposited come from.
Wait.
If she earns $4,000 at the pool and spends every penny of it on a car, you, as the parent, can legally gift $4,000 of your own money into her custodial Roth IRA. The IRS matches the contribution against her earned income limit, and the math works perfectly.
So the parent is essentially buying the child a $500,000 future trust fund for a one-time cost of $4,000 today.
Exactly. It's an incredible gift.
But let me challenge the math itself. We are talking about 50 years into the future. Because of inflation, a dollar in 2076 is not going to buy what a dollar buys today. Isn't that $450,000 figure a bit misleading in terms of actual purchasing power?
It is a totally valid critique, and we should look at the inflation-adjusted numbers to be intellectually honest. If we assume a 10% nominal return, but we factor in a historical average inflation rate of roughly 3%, our real purchasing power return is 7%.
Okay, 7% real return.
If we run that $4,000 investment for 50 years at a 7% real return, the final balance is roughly $117,000 in today's purchasing power.
That is still an incredible return on a $4,000 investment. You've secured over $100,000 of real wealth for a teenager. And it's important to note that this same independence, this separation from a traditional corporate 401k structure, applies to adult freelancers and gig workers too.
Yeah.
You aren't tied to an HR department to set this up. The Roth is entirely decentralized.
It gives ultimate flexibility to the modern gig economy worker.
All right. We have established the math, the rules, and the incredible power of time. It sounds like a guaranteed, foolproof ticket to wealth. But no system is completely idiot-proof. How do smart people actually mess this up? What are the structural errors that cause investors to lose their money or face IRS penalties?
Navigating these pitfalls is essential because the Roth wrapper only protects you if you operate strictly within its rules. Financial planners consistently identify 4 fatal mistakes. The first is simply waiting too long, which we just covered with the Emily and David scenario.
Right.
But beyond the loss of compound interest, waiting introduces eligibility risk. A lot of young professionals, maybe they are in medical residency or grinding as junior lawyers, think, I'm barely scraping by now. I'll just start maxing out my retirement accounts in 5 years when I make partner.
The arrogance of youth, assuming you can just catch up later with a bigger shovel.
Exactly. And the brutal irony is that by the time they make partner and start earning the big bucks, their MEGI has soared past 168,000, and they are completely phased out of direct Roth eligibility.
Oh, man.
They missed the easiest, cleanest window they had to build a tax-free foundation because they assumed high income would solve all their future problems.
Mistake number one, assuming your window of eligibility stays open forever. Let's move to mistake number two. I know guys who treat the Roth IRA like a tax-free casino. Because they know the gains are untaxed, they feel incentivized to take wild swings. They buy volatile crypto assets or highly concentrated penny stocks, thinking, if this moons, I'm a tax-free billionaire.
That is speculative chasing, and it is a massive error in a Roth. Remember, the Roth IRA is a tax wrapper with strict annual contribution limits. You only get $7,500 of space this year.
Right.
If you use that limited space to buy a highly speculative tech stock and the company goes bankrupt and the stock goes to zero, you haven't just lost $7,500. You have permanently destroyed that tax advantage space.
Let me make sure I understand that. If my account balance goes to zero, I can't just transfer another $7,500 in to refill it.
No. The IRS limit is based on what goes into the account, not the current balance. If you blow up your account with bad trades, the space is gone forever.
Wow.
Conversely, if you lose $7,500 in a standard taxable brokerage account, you can at least use that capital loss to offset other taxes. In a Roth, a loss is just a pure, unmitigated loss. This is why financial consensus strongly favors using broad, diversified index funds inside a Roth. Let the tax-free compounding do the heavy lifting. You don't need to swing for the fences and risk permanent destruction of your golden goose.
Don't risk the golden goose. Makes complete sense. What about mistake number three?
Breaking the withdrawal rules. We discussed earlier that you can withdraw your original contributions at any time, but human nature kicks in, and people don't keep track of their contributions versus their earnings.
I see.
A 40-year-old investor might decide they want to remodel their kitchen, so they log into their Roth IRA and drain the entire account, including the compound earnings.
And what happens when the IRS sees you pulled out earnings before age 59 and a half?
The IRS brings the hammer down. They will force you to pay ordinary income tax on all of those earnings, completely destroying the Roth advantage. Plus, they will slap you with an additional 10% early withdrawal penalty on top of the taxes.
Brutal.
You end up cannibalizing your own wealth just to finance a kitchen remodel. The government designed this to be a retirement tool, not a glorified checking account.
And the final mistake. I've seen analysts refer to this one as the silent killer, because people don't even realize it's happening to them.
The silent killer of fees. When you select the investments to place inside your Roth wrapper, you are usually buying mutual funds or ETFs. Every fund charges an expense ratio, which is an annual fee taken by the fund managers to run the portfolio. Many actively managed mutual funds, where a team of analysts is trying to pick winning stocks, will charge a fee of, say, 1.2% per year.
On the surface, 1.2% sounds like nothing. It sounds like a rounding error.
It sounds tiny until you understand the math of compounding fees. That 1.2% isn't just deducted from your returns. It is deducted from your total account balance every single year, regardless of whether the market goes up or down. To understand the devastation, compare it to a low-cost, passively managed index fund, which might charge an expense ratio of just 0.03%.
Let's run a comparison over our 40-year timeline. How much damage does a 1.2% fee actually do compared to a 0.03% fee?
Over a 40-year investing horizon, assuming regular contributions and market growth, paying a 1.2% fee instead of a 0.03% fee will devour roughly 20 to 25% of your final potential wealth.
25%?
Yes. On a portfolio that should have reached $3 million, that tiny 1.2% fee will silently siphon off over $600,000.
You are literally surrendering a quarter of your life savings to a fund manager who likely didn't even beat the market average anyway. You're buying them a yacht instead of funding your own retirement.
Precisely, which is why you must be obsessively vigilant about the expense ratios of the assets you place inside the Roth wrapper.
Okay, let's step back and survey the landscape we've covered today, because we have taken a massive, granular journey through the tax code.
We really have.
We started with two identical middle-class millionaires. We unpacked the 1997 legislative shift from tax deferral to tax-free growth. We ran the incredible math of $500 a month compounding into millions. We navigated the complexities of MBI, the precise mechanics of the backdoor Roth and the pro rata rule, and we explored how time heavily penalizes those who wait. The resounding conclusion to all of this data is that the greatest legal tax shelter in America isn't hidden in some offshore Cayman account.
Yeah.
It's a remarkably simple, highly accessible government framework that systematically rewards patience, consistency, and early intervention over market prediction.
It is the ultimate democratization of wealth building. If there is one singular principle for you to internalize from all these mechanics, it is the asymmetric power of the after-tax dollar. The decision to accept just a little bit of friction today, to carve out a few $100s a month, pay your taxes on it now, and lock it inside this specific wrapper, that single, boring decision structurally guarantees that millions of dollars in future wealth will never, ever be taxed again. It is how you take ultimate control of your financial timeline.
Taking control of the timeline, I think that is the perfect encapsulation. And as we wrap up, I want to leave you with a final, slightly provocative thought to mull over.
Yeah.
Building on what we discovered about Emily and the 16-year-old with the summer job.
Okay.
If the math undeniably proves that time is the ultimate unbeatable exponent for a Roth IRA, what would happen if we structurally integrated this into society?
That's an interesting question.
Right. How drastically would the wealth inequality gap in this country shrink if our education system prioritized opening a custodial Roth IRA for every single high school student the exact moment they received their first taxable paycheck?
Yeah.
Imagine an American economy where, simply by leveraging the physics of compounding on a few $1,000s early on, an entire generation has their baseline retirement mathematically secured before they even graduate college. Imagine what those two identical neighbors' lives would look like if they had both understood this machine when they were teenagers.
It forces you to rethink what true financial literacy actually means. The math is undeniable. It's just a matter of whether we choose to utilize it.
It really is. Thank you all for joining us on this deep dive. We'll catch you on the next one.